For introduction, managing personal finance today is increasingly complex, especially for individuals with low financial literacy who struggle with debt and poor financial decisions. Financial literacy, understanding, budgeting, saving, and debt management is crucial for economic stability, yet many still lack it due to limited education or access. Credit counseling has emerged as a key support system, particularly for those facing financial distress, offering professional guidance to improve stability. Research suggests that individuals with low financial knowledge often seek counseling, indicating it may serve as a substitute or complement to financial literacy. The objective of the study: first, to determine whether individuals with lower levels of financial literacy are more likely to seek credit counseling, suggesting that counseling serves as a safety net for those with insufficient financial knowledge. Second, to examine how external financial shocks such as job loss, income disruption, or medical emergency affect the likelihood of debt problems and the decision to pursue credit counseling. Third, to evaluate the long-term effect of early exposure to financial education on adult financial literacy and the use of financial counseling services.
Next, I will present about the importance of credit counseling and financial literacy in dealing with their individual financial problems. Credit counseling refers to the financial advisory service provided by institutions such as AKPK to help individuals manage debt and plan their finance. At the same time, financial literacy is a person's abilities to understand and manage finance wisely. Studies show that those two elements complement each other. Credit counseling not only helps to solve current financial problems, but also increase the level of financial literacy. Individuals who receive the guidance are able to budget, manage debt, and avoid excessive financial burdens. Therefore, the combination of the credit counseling and financial literacy is an important strategy in strengthening the financial well-being of our societies.
We move to the finding and the result of this analysis. First, we have the study the level of financial literacy among youths. The analysis confirmed that a strong link between financial literacy and prior financial education, suggesting education positively influences financial knowledge. However, financial literacy alone may not protect individuals, including youths, from experiencing debt problems triggered by unexpected adverse events such as health or income shock. The dataset from the UK highlight that despite variation in financial literacy level, many still face financial difficulties, indicating gaps remain that affect young people's financial resilience. Number 2, the effectiveness of the credit counseling. Credit counseling serves as a significant substitute for financial literacy in managing debt problems. The study results show that increased financial literacy may reduce the likelihood of seeking credit counseling by about 60%, indicating that those with lower financial literacy are more likely to seek professional help. This substitution effect implies that credit counseling acts as a critical safety net, particularly for individuals, including youth, who may lack sufficient financial knowledge or face unexpected financial shock. The analysis confirmed that credit counseling effectively complements financial literacy efforts by helping vulnerable households. Lastly, to propose improvement measure. Given that financial literacy alone may not prevent all financial difficulties, the study suggests a balanced approach combining financial education with robust safety net mechanism like credit counseling. Improvement measure could include enhancing financial education curriculum, particularly targeting youths to improve early financial literacy, while simultaneously expanding accessible credit counseling service. Policymakers should avoid overemphasizing financial education at the expense of support service, as both are essential to mitigate varying level of financial literacy and protect consumers against debt problems caused by exogenous shock.
Next, I will present the implication of the findings. Firstly, financial education programs and curricula. The strong association between formal financial education and improved financial knowledge suggests that integrating financial literacy into the school curriculum is beneficial and essential. The lessons should also be updated regularly to provide young people with the skills to understand and navigate the financial system. Next is the engagement of families in financial education. Family plays a significant role in shaping financial literacy, as it does not depend on only formal education. Parents and guardians should be encouraged to engage in open discussion about finance and model positive financial behaviors. For example, giving an allowance for course or teaching basic investing. Lastly is support for credit counseling services. Credit counseling may impact specific consumer behavior through increased financial knowledge. For example, once consumers understand how interest compound over time and affect the amount they will owe, they may be more likely to pay off their balance each month rather than incur interest or late fees. For the relevant to current financial, the first point is rising debt and financial stress among youth. Data show that in Malaysia, a significant number of young people are struggling with debt, with more than 53 individuals under 30 reportedly owning around 1.9 billion as of 2024. This situation can lead to larger problems, especially mounting credit card debt because they don't have enough financial knowledge. Next are economic uncertainty and financial shocks. Events like job loss, reduced income, and unexpected expenses can quickly lead to a financial crisis. This situation can be resolved by seeking credit counseling services to protect against unexpected financial setbacks. Lastly is being declared bankrupt. Being declared bankrupt is due to the consequences of high indebtedness. This situation can lead to financial stress and reduce social welfare as they will face several restrictions, including the transfer of all their assets and property to the Director General of Insolvency, DGI. For the contribution to financial education, the first point is complementary roles in consumer financial well-being. Financial education increases knowledge, confidence, and the ability to recognize when professional advice is needed, making individuals more likely to seek credit counseling when facing financial distress. This will ensure that consumers are both prepared to make sound financial decisions and equipped to seek help when necessary. Next is increasing consumer financial literacy. Formal financial education programming aim at increasing consumer financial literacy. The lack of knowledge can lead to paying higher fees, using expensive services like payday loans, or constantly making late payment on credit cards. More financial literacy means fewer costly mistakes. Lastly, financial literacy prepares people for financial emergencies. Topics such as saving or emergency preparedness get individuals ready for unexpected emergencies. Knowing how to build an emergency fund, for instance, means consumer can set aside money for unexpected medical bills or job loss.
For recommendation, integrate financial education into school curricula. The government should prioritize embedding financial education into the national curriculum starting from primary to secondary school. Core topics such as budgeting, debt management, credit system, and the importance of saving should be taught in a structured, age-appropriate manner to ensure progressive learning and long-term understanding. Additionally, educators must be properly trained to deliver this lesson effectively, as the ability to apply financial knowledge depends heavily on the quality of instruction. Second, extend financial education to families and communities. Financial education should not be confined to classrooms alone. Families and communities must also play a role in reinforcing responsible financial behavior. Parents should be encouraged to have open discussion about money and involve children in basic financial decisions. Community centers and youth organizations can support this by organizing interactive workshops or events that teach essential money management skills, helping to instill a culture of financial responsibility from a young age. The third one is raise awareness of credit counseling services. There is a critical need to increase awareness about the availability and benefits of credit counseling services, especially among young people who often seek help only after falling into serious debt. Government bodies, financial institutions, and non-profit should launch targeted awareness campaigns using social media, community outreach, and educational channels. This campaign should clearly communicate how credit counseling can provide not only debt relief but also emotional support and long-term financial recovery.